So believe it or not, stop losses are actually one of the ways that a lot of retail traders lose money. The reason is because they either exit out early or they set it at a place where it's too late to exit, and that in turn leads to a lot of losses, right, and profits, especially when it comes to stock options because of how quickly option contracts can move. And a lot of questions I've been receiving are from people who use stock price stop losses instead of option price stop losses. And they keep asking me how to set a proper stop loss because they don't know exactly where to set their stop loss, where they won't be exiting out of the trade too early if it were to hit the stop loss, but at the same time being able to give a good risk to reward ratio, right? So today I wanted to make a very quick video going over that, and I wanted to show a tool that you guys can use which could help you determine where you want to place your stop loss. So we're going to use Boeing, right? BA, for example. I'm looking at the 3-minute chart, and we're going to go look at this instance right here where the yellow circle is. And what this yellow circle represents is a theoretical position that I personally would have taken if I was here in this scenario. Now you can see that we see this bearish pattern, and especially after this full body bearish candle, I would have most likely entered right at this second candle right over here, right? When it comes to this part, if I were an inexperienced trader and I don't know fully well where to place my stop loss, it would be a tough decision to make, right? And usually most people just use option stop loss, where it's like if the option goes to 20% loss, then they immediately exit, right? But it's not the only way you could set stop losses. You can set stop losses by, let's just say, saying if Boeing were to go above 213.86, I would exit out of my puts, right? So let's say I enter into puts in the second bearish candle and I set my price stop loss right over here at 213.86. That means if Boeing were to break or touch my stop loss, I will go manually and exit the trade. Some platforms like Thinkorswim allow you to actually set a stop loss according to stop loss on your option according to the stock price. So if your platform allows you to do that, it's a very handy tool. But right here, you could see that after I enter this position, theoretically, Boeing actually had a little bit of a rally and touched our stop loss, right? And we can all be honest. Usually, if we see most of us, if we see the stock hitting coming close to our stop loss, we're very afraid to lose even more money, so we'll get out of the trade, right? But as you can see, if we actually got out of the trade when Boeing reached this point, we would have missed out on the very profitable trade for our puts. So how do we avoid that, right? How do we set a stop loss on our charts where we can look at stock price and give ourselves a little bit more room while giving us good risk and to reward ratio, right? Obviously, you can just move this line a little bit up, but we don't want to just guess, right? We want to have a little bit more technical analysis added to it. So one way you can do this is by actually going to indicators. Right now I'm on TradingView, so you can go to indicators, and what you would search up is average true range, right? Sorry, average true range, also known as ATR. So if you search up average true range and you can't find it, just search up ATR. I'll show you really quickly. If you search up ATR, you find the same thing. And what you do is you add this to your chart, obviously, and it basically shows the average volume of the candlesticks throughout the time frame or area that you're looking at, right? So as you can see over here on the bottom, it says ATR. And if you actually see right next to the letters RMA, it has a number, and that number is 0.27. So this is the number we use to actually help determine a better stop loss than, let's just say, $213.86. So now with the ATR, what we're going to do is we're going to take the 0.27 that it's given us and add it on to our stop loss over here of 213.86. What this does is it gives us a more cushion to our stop loss while also factoring in the average candle sizes, right? So it's not just a random number and we're not randomly guessing, we're actually having a calculated guess of the average candle size, so we won't get faked out by any fake pushes upwards, right? bullish trends in this scenario as we have over here. So 213.86 plus 27 should be 214.07, I believe, and we will increase it to 214.07, and now that is where our stop loss for this theoretical trade for puts would be 214.07. Now you could see that even though it has this much amount of space between the entry and our potential stop loss, it gives us a lot more room to avoid any fake outs like this one right over here. So if we were to ride this trade out, we would start losing at this point. Since we don't hit our stop loss, was continue to trend downwards and profit all the way down, and vice versa for if you're doing a stop loss for calls, right? You would take the ATR value and decrease it from the price, right? So for instance, if we put a stop loss at 210.65 and we get into calls, we'll add 27, we'll decrease 27 cents from that. So what's that? I believe that's 238, I think, right? So 210.38, so decrease the price to 210.38, right? So that's how the ATR works. It helps give a little bit more cushion to your option trades or any stock trade, and also gives you a reasonable risk to reward ratio. Just like any other indicator, make sure you use it wisely, right? Just so you guys can see, the ATR value keeps changing, right? You could see, let's see if we go to SPY, for example, ATR value is 0.39. If you guys have any questions, you can feel free to ask me in the comment section, and I'll do my best to reply. Hope you guys have a good day.